Liam Carroll is my own name, and I work with the SYS group. And I'm a financial consultant, and my objective is to help people to plan for the future and protect the present. And we do that with a range of products in the pension space, savings and investment space, and protection as well, such as life assurance, specified illness policies as well, which can help people deal with unexpected events and plan for more comfort in retirement and help them be stress-free to a certain extent in retirement anyway, John. So that's our aim when we try and meet people and individuals.
Good man. And before we move on to more pressing financial matters, tell us about your childhood and what interest did you have as a teenager?
When, John? Interest as a teenager, I suppose I'd be an avid Limerick GA fan, hurling fan.
Good man.
Would have always been into that, would have been involved in the playing capacity and the management capacity over the years, and that would have taken up a lot of the childhood. Came from a farming background, the eldest of 5 boys, and we'd have been sporty family, involved in a lot of bits and pieces like that, and we were reared on the farm, so they say I wasn't the best to help out, John, but we've done our small bit anyway to try and help out on the farm. And we did a nice childhood, thank God, anyway, and well looked after by 2 great parents. So yeah, that would be my childhood.
And did you grow up on a dairy farm or a beef farm or a tillage farm?
Both dairy and beef. I think dairy. My brother now is farming it at home, and he was actually on the radio last week. Would you believe, John? Because the bypass is going through very close to it's going through part of our land at home and going very close to my parents' house and my brother's house. So that's a bone of contention at the moment anyway. So there's a bit of fun and games about that, John. So dairy and tillage, or dairy and beef, sorry, but primarily dairy would have been the main income.
You're based in the Golden Vale, obviously. And is this bypass you're mentioning, is this the proposed Limerick to Cork motorway or a ring road around Limerick city?
No, apologies, John. Yeah, 100% right. It's the Limerick to Cork motorway. So our home will be between Charleville and Croom as you're going towards Charleville into the right-hand side. So that's where the farm will be. And it'll be all fun and games now when this gets going, John, I think,
So you're East Limerick man, effectively.
Well, West Limerick is our GA title, but I think we're close enough to the Charleville border, so it'll be the south of the county, really, I think, a lot of the time. So, yeah.
Oh, very good, yes. I always remember being on a train to Cork one time, and the train pulled into Charleville station, and this man said to his grandson, "Where are you?" He says, "I'm on the train." He says, "You're in the County Cork, boy."
Very good, John.
Yeah. As regards hurling, obviously Limerick have won 3 of the last 4 All-Ireland finals.
John,
What do you think they'll do this year?
I'd be hopeful, John. I think we're we're privileged to be living in the times we're in as Limerick hurling fans. They're great. They're a great bunch. They've represented Limerick absolutely superbly. They've portrayed Limerick in a very positive light, and they had a poor league campaign by their own admission, but I think we have to trust the management that they know what they're doing and that they'll get it right on the big days, and I've no doubt that they will. And they're just a fantastic bunch, and it's a privilege to be supporting them, really. And we're very, very lucky, John.
There's some very good, skillful hurlers in that team, like Keane Lynch, for example, Dan Morrissey, Tom Morrissey, Aaron Gillan, Kyle Hayes. There's some tremendous hurlers in that team. I think they have a great chance of returning the All-Ireland final this year, and perhaps Waterford would be their biggest rivals for the title. But we'll see what happens. Describe, what advice would you give to a 25-year-old person who's starting out working in the private sector in terms of pension provision?
Yeah, John, advice, I suppose, for people at that age is a pension is a fantastic tax-saving vehicle for people to take out, whereby there's huge advantages in that point of view. You don't pay tax on the money that goes in. You don't pay tax on the money that's invested. And once you work it properly, you don't pay tax on the money that comes out the other side. So that's it in a basic nutshell, the advantages of a pension. But in a lot of cases, people are at different stages of life. When you're 25-year-old, you might be looking at a deposit for a house in a couple of years' time, and all that kind of stuff. So putting money away into a pension where it's tied away for long-term mightn't suit some people. But it's never too young, or you're never too young or too old to start a pension. And the point of view is that you're building for your long-term future and long-term successes, I suppose, from that point of view. So it's a fantastic thing to do if you can start off early, John, from a tax saving or from a future protection point of view. Like, but it mightn't just suit people at the stage of life that they're at a lot of times. So that's where we come in. That we'll have a chat with people and we'll try and guide them as best we can through that process to see is it for them and go from there.
Thank you for that. And for a person who's probably 45, 50 plus, how can they protect their pensions against rising inflation, which we have at the moment?
Yeah, it's interesting, John. I suppose it's very hard to protect anything against inflation from the point of view you're hoping to make returns on the money that you invest away, and that is the only way of I suppose protecting against inflation. But that's easier said than done, and it's very like people who say you should put the money into cash now or you should take it out and put into. It's very, very difficult to time the markets, and I think for people that it's very important that you're part of a long-term journey, so that you're not thinking that I need to have make 10% in 2 years and 20%. You need to be looking at it over the long term and try and make a steady increase on your monies and be invested in funds that suit your attitude to risk, John. So my opinion on it is like that if you have an individual that's, as you said, they're 25-year-old starting off, he can afford to take an element of risk with his money because it has so much time to come back in the event of there being a downturn. But if you had someone on the opposite scale, John, that's maybe age 64 and once retired 65, there is no way that they should be invested in funds that have an element of risk on them. Like, so it all comes down to the stage that an individual is at that point and their attitude to risk and the length of time they have before they need to go accessing the money. If that answers the question.
I know what you're saying there, yes. So the older you are, you want to, have a less risky profile in terms of equities and other investments. You might want to have a larger amount of your pension pot in cash because it seems to be less risky. And if there's a market downturn, you won't be as badly affected as a person who has their pension invested into, say, Far Eastern stocks, for example, or technology stocks, where you can get a boom and a bust over a short period of time.
Very well put, John. Yeah, that's exactly how I would agree with you there. Yeah.
And can a person pay into a pension scheme indefinitely or beyond their normal retirement age?
As in, if they're looking to retire at the age of
65, 66, can they continue to pay into that pension scheme?
Once you're in employment, John, you can. If you're out of employment, then you can take out what they call a PRSA. But it's really, if someone is at the age and they're not earning as much money and say they're not paying tax and so on and so forth, it mightn't be as advantageous for them to put the money into a pension pot. It might be better for them to have it on deposit from that point of view. But like you see a lot of people there where they might be at the age of, a few people, John, at the age of maybe 55, and they'd say, "Oh, I've no pension in place, but it's too late for me now," and so on and so forth. But I would argue differently. I think it's definitely not too late, and that you have an opportunity to put money away into a pension as against putting it into a savings plan where you're getting full tax relief on the monies you're putting through. So it's a fantastic opportunity for people at that stage to put monies away, even if they've nothing started, John. So I think that's a very important message that needs to be got out there towards people, and you can look at it as a savings plan where you're up 40% before you start, if that makes sense.
I know what you mean, yeah. What is the benefit of having a critical illness policy?
Yeah, I suppose a specified illness policy, as we call it, John, it's a very, very beneficial policy to have. I'll give you an example of a guy that a good friend of mine took out a policy about 5 or 6 years ago at this stage, I'd say, and took out 100,000 specified illness cover. And unfortunately, the same man got a stroke at Christmas time. He has 2 young children, both one a young teenager and one going towards the latter end of the teenage years. And he had a check of 100,000 paid into his account last Saturday week. And I think pure outside of the financial benefit of it, John, that there's a huge element of psychological assistance came from that payment, in that he's not worried now about where the next bit of money is going to come from to pay bills. And it has I think it'll positively impact upon his recuperation. So I think it's a very, very beneficial thing to have. But a lot of the time, I'd be of the opinion, John, that these things are very more important to have when you have dependents.
Yeah.
So that God forbid, if something happens to you, the people that are fully dependent on you, that they are covered financially. Obviously, we're talking purely financial here, and not talking about any psychological effects, but it's purely a financial perspective, that they're covered and your income is replaced from that point of view. Then, John, if that adds up, makes sense to you?
It does indeed, yes. Yeah, I know what you're saying there. You get, if you have a critical illness policy and you become seriously ill, you get a one-off payment, and you can use that payment to finance your lifestyle for whatever period of time needs be.
Right. Yeah.
Or you can decide to pay off a mortgage if you have a mortgage in place, and therefore reduce your financial outgoings on a monthly basis.
Simple as that, yeah.
What is the benefit of having an income protection policy as against a critical illness policy?
Yeah, they're both very good policies, John. They're different in that income protection will provide you with an income. So with an income protection policy, maybe if we take that gentleman there, for example, right? No, he didn't have an income protection policy in place, but if he did, and he took it out, and it was what we call a 13-week deferred period on it. So that would mean that he wouldn't be paid for the first 13 weeks. When that policy then kicks in, he is paid the amount that he agreed at the outset in relation to the cover up until he is okay to go back to work. So if he's not able to go back to work until the age of 65 and he picks that age to finish up, then he's going to be paid on a monthly basis into his account from the insurance company from there on. The specified illness policy is a one-off payment that will be made into him. So there's pros and cons to both. I would think a mixture of both is the ideal way to go. Maybe a lower amount of specified illness with an income protection policy as well, which will give you a lump sum to start off with in the event of a specified illness, and then you'll have your income protected to up to 75% of it from there on then, John. Does that answer the question fairly?
It does indeed, yes. I know what you're saying there. Yeah. So for example, if a person has 100,000 of a mortgage, perhaps a critical illness policy of 100,000 is sufficient, and that will pay off the mortgage in the event you become seriously ill. Right. You also want to have a income protection policy to give you cash flow to meet your monthly commitments, such as gas bills, food, electricity.
Exactly,
yeah.
And the specified illness policy, or critical illness, whichever way you want to word it, it doesn't have to be used to pay off a mortgage as such. It can be left there and used to pay your mortgage repayments and pay your gas and oil or whatever it is. Yeah. And it'll just be there for that purpose. But it's up to you what way you want to utilize it, John, once you take it out. True. Protection of yourself.
Yeah. I know, for example, here in Ireland, when you take out a mortgage, you must take out life assurance. That's compulsory. Otherwise, you won't get a mortgage. Right. I think it's different in the UK, from my memory. You can take out a mortgage in the UK without having the life assurance policy in place, because many employers have a death in service benefit.
Yeah.
What are the main, aside from cash and equities, what other investments can people make when they're building their pension fund?
Yeah, there's a lot of bonds out there, government bonds and corporate bonds, John. So there's 4 main asset classes. There will be equities, bonds, cash, and property. And property is now there's some IOPs have some new regulation out, but just to give if you're talking to somebody, we need to go into them in more detail on that side of it, because there is some regulations and there's no point really going into them in too much detail here, John. But what some people have done is they've actually purchased a property with their pension. Mm-hmm. So what that means is that if you purchase a property with your pension, the pension owns the property, and then the rental income that goes in as a gross figure into your pension pot. And then when the pension goes to sell the property afterwards, the CGT doesn't apply on it. So there's a huge tax incentive in relation to people purchasing property with their pension. But we need to talk to people if they were looking at doing it, because you need to have your pension at a certain level with the new IOPS rules on it as well, and you need to have some liquidity and things inside in it. But it has proven to be very popular with people that have a large lump sum built up in their pension that's just sitting there, and the Irish being the Irish, they like to have they like bricks and mortar, John, to form part of their portfolio. So that's part of it, and that's something that has become more popular in the last couple of years. And property then is down as an asset class as part of a regular pension pot. So basically, you could New Ireland, for example, have a property portfolio, and it's invested in hundreds of different properties, and the money comes from the rental income that comes into those properties. It provides yields which are used to give a return to clients inside in their pension portfolio. So it's spread over a huge amount of property, so the exposure isn't there to if any one property isn't occupancy is low, it doesn't affect the fund overall. So there are a couple of different angles, John, on it for people who are investing money into their pensions.
And what about green energy investments?
Yeah, there's a lot of talk about that at the moment, John, that people are looking to become more ecologically friendly and invest money into that. I think there's the companies are going to be encouraging it as well. And I think as well, it is going to become more popular, John, because of especially with the Ukrainian crisis. And obviously we pass on our sympathies to all the people involved, and we're just talking purely from a financial point of view here, John, but the price of gas and oil is going to become unsustainable. So obviously the green sector is going to become more profitable, and people will be looking for greater investments into it. So I think down the line, John, it could become a very sector where people will be looking at investing more monies into. And I suppose and then the people who manage the pension portfolios, are they going to maybe try and increase their exposure to the green side of it to try and make a return for clients? So it'll be very interesting the way it'll go down the line, John, won't it?
It will indeed, yes. I think we're going to be forced into a lot of decarbonisation of the economy. And of course, areas like wind farm, onshore and offshore, wave power, solar energy, I think there's going to be a massive investment there into those technologies over the next couple of years. And we also, of course, have electrical vehicles, hybrid vehicles. And I was just reading an article there yesterday on rte.ie that Russia is one of the biggest suppliers within the world of some of the rare materials that are needed to build lithium batteries for electric vehicles. So there's a lot of uncertainty out there at the moment.
Yeah, it's unbelievable, really. Like, it's just the times we're in, John. A couple of years ago, if we spoke about we had a world war coming up and we had a crisis with a global pandemic, like, would we have believed it? Like, it's incredible times we're living in, isn't it?
True. What advice would you give to an employee who's in a company pension scheme? If they leave that business or that company, should they leave their pension with the company or put it into a personal retirement bond?
Yeah, come on, John. It comes down, John, to an individual as such. In that there's a couple of different types of pensions. A lot of the older type pensions were defined benefit pensions, and in a lot of occasions, it mightn't be in the client's best interest to move that into a retirement bond, because the pension for life that they will be receiving from it might outweigh the benefits of putting it into a retirement bond. Ordinarily, now every case is different, so we have to put that caveat in there, John, but ordinarily, if people are moving from a company pension scheme, that it's better for them to put the money into a personal retirement bond. But again, that can change with different circumstances. But ordinarily, we'd be advising people to put the money into a personal retirement bond. And what it does is it gives people control over the management charges, the funds that it's invested in, and you'd have access to an advisor as well on a more regular basis, which means that it's easier to keep in touch with your policy and make sure that it's performing the way that you're looking for it to perform. And then as well, and again, each case is different, but it can form part of your estate, and we need to speak to people about that, because depending on your current pension arrangements and things like that, now it's a bit technical to be run into, but it can form part of your estate as well, and it's an awful lot easier to get that part of it sorted when it's in a personal retirement bond, rather than being part of your employer's pension scheme where you're not a member of the company anymore. So it's generally, yes, John, I would say a personal retirement bond, but every case is different.
And of course, in the case of defined benefit pension schemes, particularly within the private sector, they've become increasingly rare over the last 10 or 12 years. Many companies have closed them out to new entrants or closed them entirely because the assets within the pension scheme were not sufficient to meet the liabilities, present and future. So they've closed them out. And I know in some cases, people have been told that the pension scheme has been closed. We're converting it to a money purchase type scheme. So the liability for the performance of the pension scheme is on the employee, not on the employer, and their investments going forward.
Yeah, in a lot of those cases, John, as well, that people, it's moved from a defined benefit to defined contribution, and people will get an option letter to sign it. But it's important for them to note like that they'll be getting an enhanced transfer value for doing it. So basically, the insurance company will give them an extra bonus, I suppose, for moving the money over to a defined contribution. And as you kind of mentioned there a minute ago, sometimes there's a worry with these defined benefit. Are they going to be underfunded and mightn't have the money in place to meet their obligations to the members going forward? So it's very important to weigh all those things up and try and make sure that you're not exposed, even though it might look like a fantastic thing that you have with your defined benefit. So every case is different, John, isn't it? But it's just to try and go through these things in detail and make sure you're doing the right thing for your future.
That's what keeps the actuaries employed and earning big money, is investigating all these defined benefit pension schemes and money purchase pension schemes. It's right, work way beyond my head, but there you go.
Oh yeah, big time. All our heads, John, I think. But anyway, yeah.
But it keeps them actively involved and actively engaged, I suppose you could say. What do you think is the future of work within the financial services sector?
What do I think is the future of work? I find the first part of it is from purely a work perspective, it has completely changed. I think it's gone an awful lot more of a hybrid model in that you've an awful lot of things on Zoom and those mediums of transacting business, where before it was completely dominated face to face. So that element of it has changed in a massive way. I think we all know from going into banks and things, they were before the COVID, they don't really like dealing with people face to face. They want you, they're encouraging you to go online. So that's one angle of it as well. And I think Ireland follows the British models an awful lot when it comes to the financial services. And on that side of it, an awful lot of things are gone fee-based over there. So if somebody is advising an individual here on their policies, it could be a case of going forward that they might have to pay an advisor a fee in order to look after their business. Whereas heretofore, it would have been taken, there would have been a management charge on the policy, and the advisor would have been paid out of the management charge. So it'll be interesting to see what way the regulator looks at those things going forward, John. But it has completely changed from the point of view of the Zoom has been a game changer for everybody, I think, in the industry that has embraced it. And I find it has been a fantastic thing, John, for servicing clients. So if you have a client on your books and you just need to do a 10-minute call with them, maybe just to have a look at the policy, and it's fantastic to be able to do these things on Zoom, and the clients are very appreciative of it as well. So those are the couple of bits and pieces. If that answers your question, okay, John?
It does indeed, yeah.
Yeah.
So 3 takeaways from today's interview with Liam has been, firstly, it's never too late to decide to take out a personal or private pension scheme. And the sooner you do it, the better for yourself.
Yeah.
But in doing so, you have to consider what other financial liabilities you have, such as a mortgage payment, for example. Also, be prepared to consider a critical illness policy and an income protection policy, particularly if you have dependents in your household.
Yeah.
And also, as you approach retirement, don't leave your pension funds left in a risky investment. Consider moving your pension scheme or pension funds into cash, because as you approach retirement, you're less likely to suffer from any market downfall. Is there anything else you'd like to say to the audience before I let you go, Liam?
Oh, come on, John. I hadn't. It's very easy to answer questions. It's very hard to think up with something like that now on the spur of the moment. Not really, John, except to say that it's important for people just to have a look at the policies that they have in place, be it protection and savings, investments and pensions, and even just to meet an advisor and have a chat with them to make sure, are the policies they have in place suitable for their current circumstances and their current needs? Because a lot of the time someone will take out a policy a couple of years ago and just leave it there, and they might have had children in the meantime, or they might have had say the mortgage might be paid off and that policy mightn't be suitable, or they might be earning more, so they need to put in more into the pension to save money on the tax side of it and to prepare for the future. So it's important just to do a review every couple of years on it to make sure that the policies you took out a couple of years ago, which were correct for your stage, are still correct and still suitable for your needs. So that's probably the one thing I'd add to John, if that's okay with you.
Indeed. And on that note, I'll bring today's show to a close. Thank you, Liam.
Thanks very much, John. Thanks for having me.
You're very welcome.
Best of luck with your show as well going forward. Thank you.
Thank you.